Welcome, everyone, to tonight's Hook Up with Real Estate Masterclass. We're super excited you're here with us tonight. We have a very special guest, Scott Kidd, and I'll be introducing him in just a minute. First, we do need to read the disclaimer. So, Ken, would you mind picking out the highlights?
Sure will. We appreciate you attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hook Up with Real Estate and its representatives are not liable for any outcomes resulting from the information provided or engagements with third-party providers. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
What you put it? Don't market me.
Oh, sorry, Juanita, can you go on mute?
Nope.
All right, next page. Okay, so our mission is to empower aspiring and early real estate investors with exceptional education, invaluable skills training, and genuine opportunities to invest in real estate while simultaneously sharing strategies that guide you toward success in real estate and away from costly mistakes like we made early on in our journey. All right, and you can read about that journey in the book called Real Women in Real Estate. I have a chapter in there. It's available on Amazon, or I can send you a signed copy. Ken is a licensed realtor in New Jersey, northern New Jersey. So if you happen to be in this area looking, please reach out to him. He's also a veteran, maybe. Okay, we are powered by Legends Equity Group, and this is one of our properties here. It's a 30-unit multifamily. This is our leader here, Alex Lee. This is an event that he held, so not everybody here is in Legends, but anyway, he does have a 30-day challenge for no money, no credit, no excuses, no cost on school.com/real estate club. This is all free, so it will help you with your skills training. And this is a property that is industrial. It is a 506C, meaning for accredited investors only. It's closing in 2 days. There's an industrial property here in a development section here. Oh, sorry, could you mute yourself? Thanks. Anyway, if you want more details, I'm happy to share that with you. So this is our updated calendar. Next month, we had thought we would be on the 3rd Wednesday, but we're back to the 4th. So I did send it out with the notice. And let's keep going. There are 2 ways that you can stay connected to us. One is through our YouTube channel, which this replay will be there. And it's youtube.com/@hookupwithrealestate. And we also have a Facebook page, groups/hookupwithrealestate. Hang with us. Ken, would you read the quote of the day?
To reach a port, we must sail. Sail, not tie and anchor. Sail, not drift. Franklin D. Roosevelt.
Thank you. But that was apropos for our guest. All right. Now we get to the good stuff. I am going to introduce our special guest, Scott Kidd. He has over 25 years of maritime experience, including new builds, refits, project management, and yacht management. He is licensed United States Coast Guard Master of 1,600 U.S. tonnage and 3,000 international all oceans. He also has a background in IT and a strong mechanical background in maritime transportation, machinery, heavy equipment, and commercial real estate too. In his career, his cruising includes the Mediterranean, the Gulf Coast, including the Gulf of Mexico or the Gulf of America, whichever you choose, Great Lakes, Pacific, Alaska to Panama, Atlantic Canada to Florida, the Caribbean, the Bahamas, and South Sea China on board yachts. It's very exciting. But Scott has been a multifamily real estate investor for the past few years. He's invested in multifamily apartment syndications in Ohio. We have a guest here, Juanita from Ohio, North Carolina, Texas, and joint ventures in Florida. Scott also hosts the Yacht Captain Investor Podcast, and he runs a monthly meetup group, Yachtie Real Estate Investors in Florida, Fort Lauderdale, West Palm Beach, and Stewart, in collaboration with the Like-Minded Real Estate Network. I'm going to stop sharing, but please help me welcome Scott as we talk about how to build passive income through multifamily real estate investing. Welcome, Scott.
Thank you. Appreciate you guys having me here. Thank you so much. Happy to be here.
Awesome. So tell us, Scott, how did you actually get involved in real estate?
Well, I started like a lot of people, as the family got bigger, we bought a bigger house and we rented the first house, and then we kept going that way. And my intention was to keep buying another house every so often. And that's what we were looking at doing. But fast forward quite a bit, working on yachts are kind of an unstable business. So I was always looking for something for stable cash flow, because it's not if, it's when you lose the job. And I'm sure that's the case with a lot of other fields these days. But I was there at the beach in Fort Lauderdale with a friend, and he told me he had bought and sold a 46-unit apartment unit in Houston, Texas. And he said, he said he had made it, well into the seven figures on it, and him and his brother. And I said, "You can do that?" And he said, "Yeah, you can do that. I did it. Anybody can do it." And so that kind of started my journey on that. I started to learn and went from there, and then, started small with some joint ventures and then moved up into syndications.
Well, let's talk about that learning journey. How did you go about learning about multifamily?
YouTube University. That was the most of it. And plus, I just read every book I could get my hands on, and still read it all the time today. Is still learning, as we know, in this kind of environment. Everything changes all the time, and each deal is different. So you have to be nimble and be able to pivot and plug in what works. And YouTube has probably been one of the best things, and it also helped me find meetups and eventually starting my own meetup and collaborating with a lot of people.
That's awesome. So since you mentioned books, are there any books that really stand out for you for aspiring or early realists?
One that I've read more and more, probably at least 3 times, probably more, and I flip back and forth into it. It is The Hands-Off Real Estate Investor by Brian Burke. It's written for the passive investor, what to look for, and it has really helped me as being a GP and an LP, just helping figure out what is best for the investor, because it's all about what the investor wants, not what you want. Just because I think it's a good deal doesn't mean it's a good fit for you.
Yeah, so just to clarify, when you say GP and LP, can you explain that a little bit?
Yes, sorry about that. It's limited partner is you have limited partners and general partners. Just think of the general partners are the ones that are operating the deal and finding the deal, sourcing the deal, raising the money for the deal, closing on the deal. They're basically doing all the work. They're hands-on active partners. And the limited partners are the ones that are putting in the money, and they are passive. You're not really on the operations side at all. You do get privy to information of what's going on and everything else, and that's basically how syndication works. It's just yourself and a group of investors putting money together, and you are actually selling a security when you are soliciting a security when you are soliciting investors.
Thank you for that. So you heard your friend talk about buying and selling multifamily. So what was, I mean, beside the potential for the income, was there anything about multifamily that drew you in?
Well, from what he was telling me about, all the economies of scale, and if you lose, because it's like at that point with the rental houses that I had, a house that I had, if the tenant moved out, then I have to pay the mortgage, I have to pay all the money to, recoup whatever's broken. I have to market it again with a property manager. But if you have, say 50 units, if one or two people move out, you're not really necessarily going to be hurting if you're operating it correctly, because you have those economies of scale. And if it was cash flowing, then you also would have reserves. And then you have one roof instead of, if you have 20 or 30 houses, you're going to have 20 roofs. You have 20 insurance policies, 20 landscape bills you have to pay. It's going to be a lot more effort rather than having it all in one place.
Yeah, that makes sense. We are single family homeowners. That's how we started 20 years ago, but we have since moved into commercial real estate as well.
Nice.
So when you started, did you start right away as a limited partner earning passive income, or did you start, you wanted to be more active?
I kind of did both at the same time. I started as a limited partner. I invested in a syndication in Ohio, and also I partnered with someone I met at a meetup. She and I are still partners today. It's now 4 years later on that joint venture, and ourselves and three other partners. And it's a joint venture because it's not a syndication, because we're all active in the deal. Because with a joint venture, everyone has to be doing some form of duty, or else it would be considered a security and it would be a syndication. If you can't just put the money in, you have to do something active. Like, we all go to the meetings and we strategize on what needs to get done, and some of us go to the property and actually fix stuff or manage the contractors. We have meetings every so often about, every quarter, about all the logistics. So we did that, and this invested as a limited partner at the same time, because I wanted to be active and passive, and so I could learn a lot faster on how everything worked.
Yeah, that's awesome. We started as a limited partner also, but tell us, what did you learn? What do you learn being a limited partner? Good and bad, right?
Well,
Pros
good and bad. If you like to be in control, it's probably not the best thing for you, because it's generally a lot of the syndicators and operators, you probably get a monthly newsletter. And I would suggest, if you are looking to get into syndications and want to be a general partner, think really hard about it, because it's a very active job. It is a very busy job. It's another job. You have to be an active participant, whatever you're doing. You have to be, and you also, everyone usually on smaller deals and stuff, everyone is responsible on some level of raising some capital and helping bring money into the deal. So it helped me, because I was lucky enough, the syndications that I got involved with, the operator was open to helping me, and I was able to call them and see what they were, what was going on. Every couple of weeks, they would tell me and share me with me what was going on, and I was able to sit in on some of the, not only the investor meetings, but also the general partner meetings where they went through, the expenses, what projects were going on. Hey, we have 3 units that need to be turned over this month, which means the residents moved out, so then it has to be fixed up and cleaned and prepped and everything for the next, residents to come in. So that was a really big help. And followed along that way, and it helped me kind of it was a pretty steep learning curve for me because it was something very new to me.
Yeah, so we are GPs on the 30 unit that we showed in the PowerPoint, and also on the investor call, well, less on the investor call, but more on the GP call every week.
Yeah.
And
Nice.
I mean, things you don't expect. So what are some of the things that you don't expect that might come up on the general?
Some of the things that I didn't expect was, well, I knew it was a lot of work, but I didn't realize that like a lot of things, all the different facets that went into it, especially like a large rehab, because I had done some rehabs on some properties, and had also done some major refits on the yachts too, which it's pretty intensive, where project management is pretty heavy. I just did not realize, like, because the property was in Ohio and I live in Florida, I didn't really think about the winter season, and like that contractors kind of slow up in the wintertime. I was like, oh, wait a minute, that's a big deal, because they can only really do the inside work. The outside work is not as prevalent, and then certain things just aren't going to happen, especially if it snows and stuff like that. So that was something that was a big learning curve for me, because I was thinking they were just going to work straight through, and they said no, then we have to go and do all the inside work, and then if there is no inside work, then we have to kind of hold until it thaws out. And I that was something that I learned, that geography really played into. It was a common sense thing that I probably should have thought about before, but it was something I didn't take into account, because it's in Florida, it's wet or rainy or hot, and that's it.
Occasional tornadoes or hurricanes.
Occasional hurricanes, but we try not to think about those.
Yeah, right. You're not building in a hurricane.
Yeah. No, we're not doing that either.
Yeah.
Rebuilding after.
So the first property was basically already found when you participated as a limited partner.
Yes.
So what about the property that you became a JV on? Did someone else in your team find the property, or how are you going
Yes.
about finding?
I did not find it, but it was from a meetup that I went to, and I strongly recommend going to as many meetups as you can to meet as many people as you can. So find ones that are aligned to you. My partner, she came to me eventually after we'd known each other for a while, that if I wanted to partner on this 13 unit in the Daytona area. And I looked at it, and I drove up there and look, it was a few hours from my house, and which is good, because it was far enough away to where I couldn't drive by there all the time.
Yeah, right.
Which
But it is
is
important
good.
to do the due diligence. So
Yes.
beyond like doing a drive-by, how did you do your due diligence?
Well, I looked through all the documents, and I went there for some of, drove by there, a couple of times, and then looked through all the inspections reports, and looked at all the property history. We did the numbers. We did all the underwriting, all the stuff that went through all the projects that needed to be done. We made a business plan and cost out everything we saw that needed to be done based on the inspection. And there weren't any major rehabs other than the roof was going to have to be done at some point. Um, we felt it was going to probably be a few years. However, after we owned it, it ended up, we found Green, what was it called? There's a company, Y Green in Florida. I think it's nationwide PACE funding. They'll do, you can update the roof and they will finance it through your tax bill. And you don't pay any upfront money, provided you use the certain taxes, certain contractors. And that ended up being a really good deal because we didn't go out of pocket because one of the roofs really needed to be done. So we ended up doing all of them, which really upgraded the property. And we were able to do all the other work around. So it's pretty well running pretty well now, 4 years later.
That's awesome. So let's talk a little bit about passive income since, you know, so you're evaluating the property, you're doing your due diligence. So what was it that gave you the indication that you would be able to get passive income from this type?
Well, I did my underwriting, and I had underwritten probably, I don't know how many, hundreds at that point, just so I can understand it more, everything that was going into the syndications, and did my analysis of the area. And what was most important was the operator. Did I feel comfortable that whatever happened, they would be able to, make a plan to fix it, and as you see now over the last few years, things have changed a lot. There were things that weren't anticipated. And that particular property in Ohio, it was going to be a 3-year hold, but now it's been extended just because of where everything is and the rates and everything and the interest rates, mortgage rates. But the good thing is that they had the wherewithal to assume the loan, and there's another 10 years left on the loan, so it can hold for quite a bit longer, which was something that I was pretty comfortable with. That was something that I really liked about it, and the interest rate was 4.3%, which was quite a good rate compared to right now, which you're looking in mid sixes, I imagine.
Now, you raised some important points about the operators. So tell us a little bit about how you evaluated the operator.
Well, basically, I looked hard at their track record, who was on the team, if they had any properties that were going bad. I did, asked around. What's one thing that I've learned since to ask is, can I speak to some of your other partners or some of your other investors and ask them about their experience, and something that I think is just a small thing, is how they communicate with you. Like if they're very responsive to you in the beginning, more than likely if things go bad, they'll probably be pretty responsive. Because if things go bad, I want to know whether good, bad, or indifferent. Let me know what's going on so I can say, because I'm the one taking the risk with the money. So, if hey, we have to put another roof on, it's going to be another 50,000. Please let us know, because then we're thinking we're going to potentially get a distribution or a dividend or a month, money that quarter. And, don't tell us on the last day or after. Say, hey, the roof is going, we're going to need to redo it. So let us, and if they let you know ahead of time, then I'm okay with that, because things happen, and that way that they're being proactive also, that they're going to foresee a lot of the problems, where if they're reactive, then it'll probably end up costing you more money, and the property more money.
Yes, so in terms of, oh, you were talking about roofs. We have an industrial property that we're invested in, and they had a little challenge with the roof, so they held the distribution for a month. They just
Okay.
fixed the roof. I got the email today, so they're going to reinstate the distributions. But, it is really all about the communication, even
Yes.
during the hard times.
It really is. And if how they communicate with you in the beginning is more than likely how they're going to communicate with you throughout. And if they're, you know, you don't want someone that's very high strung. You want someone that's going to, you know, dig in there when there's a problem and move ahead. And I strongly suggest, it's okay to ask for background checks and if they've had any defaults on any properties and credit checks and stuff like that. And if they're not okay with disclosing that information, then you probably should go with someone else because they should be open and honest because things happen. We've all made bad deals, things have gone wrong, and we've lost money here and there and made money here and there, and it's a part of life. A lot of things don't work out. I mean, there's a lot of properties in kind of a default or a kind of a gray area now because no one's anticipated the rates going up that quick. And a lot of people had a rate lock, which you can pay money to lock the rate at a certain interest rate, but it might have been only for 2 or 3 years. And that time is probably past now. So then they might have gone from a 4% interest rate to 6.5%. And at that point, the numbers may not work. They might be underwater. So
Yeah, I hear about that a lot now.
yeah, it's happening.
So how do you actually calculate, I'm looking to get X passive income, or, you're looking at somebody's potential business plan. Like, how
Well,
realistic are those?
um, I would do your own due diligence, like you were saying, and don't ever don't ever take the pro forma or the numbers that they send you as this is how it is. Do your own due diligence. Check, apartments.com or rentometer. See, maybe check around, see what the actual rents are. That kind of thing is always important. Um, you know, interview if you get the opportunity, ask the other partners, and find out who was in charge of what. Because to do the numbers, you really have to dig deeper than just taking what they have. I have a couple of different deal calculators that I use where I can plug in the numbers, and there's quite a few of them available. And now with AI, some of these are getting even better. They're probably way better than the spreadsheet that I use. I should probably upgrade. But you always there's a couple of quick rules that you can do is the net operating income, which is basically the all the rent minus the expenses. That's going to be your net operating income and not including the mortgage, not including the debt. And you compare that to the price and you divide that and that'll get you your capitalization rate, which they call a cap rate. And check and see if that is within range. You can ask other brokers and see to do your diligence. You can call some of them and say you're looking at this deal and say, do these numbers look right and stuff like that. And by calling other brokers in the area too, you might be looking for a deal in that area at some point, and then you can keep building on those relationships as well. So, if you also have other friends or a group like this, have other people put eyes on it too and ask what they think as well. I would strongly suggest that too, because you want to cross check and see if anybody else knows about the area the building. Somebody might know some history about it.
Yeah, to your point, on Monday at 5:30 Eastern, run a very small group. If anyone has a deal and they want to bring it, we'll start out with napkin underwriting, and then
Oh yeah,
looks
nice.
good, we'll go into a deeper dive.
Yeah, there's some there was one, I think it might have been a Michael Blanc one. It was a simple deal calculator, and you just plug in a couple of numbers, and then if it worked, then you move forward. You know, it was pretty helpful to me because then I was able to start doing it in my head with those, and then just okay, no, 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 and then after a while, but that was after looking at a lot of deals, so you know.
Yeah. So when you're looking at deals, what are you looking for?
For me, I have changed what they call my buy box or what I invest box. And I also have a list of like 100+ questions that I ask the operator and ask other people. And I'll gladly share it with you and the group if anybody wants
Be
it. I'll
great.
email it
Yes.
to you
Thank
later.
you.
Because it's with by doing that, asking these questions and looking at these certain things, like for me to underwrite the deal, what I'm looking at right now is I'm looking at stable multifamily deals, Class A, which Class A is generally 2,000 and above to brand new developments, with all the amenities.
2,000 units and above?
No, to that year 2000 and
Oh,
above.
year 2000.
Year 2000 and above, you're probably looking at a few hundred units, a few hundred doors. We say doors, or units for the count. And they're stable, not really a whole lot of value add, which value add is where you're going to come in and do a lot of work and get the property fixed up. I like stable deals because generally if they're newer, you're not going to have a lot of maintenance. So the cost is probably going to be, the cost to maintain these properties is going to be a lot less. So then, but the returns may not be as good, but they will be stable. You're probably not going to have as many problems with that. And that's just what I've grown accustomed to. I'd rather have the steady numbers than, the promise of the big pop at the end or in the middle. Because, as you see now for me with laborers can be kind of tough. Supply chains can be kind of tough right now. Inflation with a lot of these goods and stuff and tariffs could be affecting the pricing of just rebuilding a unit. If you don't have to go through all that and you get a little bit less of a return, I'm okay with that. It'll be steady and stable, and you won't get the call from the general partner and say, hey, we've frozen distributions because we couldn't get all the windows, or we ran out of lumber, or something like that, or we raised the prices per unit to do a rehab because the sheetrock was so much more expensive. That's what I look at, and I've probably gotten a lot more. My risk tolerance is pretty high, but I've kind of scaled back because I want to go into more stable assets and also new development. We're also starting a fund for new development in Dallas. We've partnered with a developer there that's has 30+ years of experience.
Fantastic. So you reminded me, we had a single family, I think it was during COVID, we were trying to, okay, there's a question, what are stable assets? But I'll just tell my story, and then
Okay.
it took us 6 months during COVID to be able to get
Oh yeah.
windows. So
Yeah, that was,
yeah,
we had an 8 unit that we we ended up, because we had got the windows re-permitted, but we couldn't get the sizes that we needed. So we just bought whatever we could off the shelf and made them fit. And the inspector was nice enough to say, okay, we can change the plan because you can't get the windows. And it was the best we could do, because it was, like you said, it was 6 months on some of the windows, but yeah, it had its issues during COVID to get those things done, but we got it done. I mean, I imagine you guys did too.
Yeah, we got it done. We just had to
Yeah.
wait, be patient.
Yeah, but to answer the question about stable assets, are assets that are, um, when I mean assets, is multifamily or proper, or any of the properties and assets. So the stable ones are the ones where you don't need any big rehab budget. They're already cash flowing, and their occupancy is in the 90%, so that they're stable and cash flowing. That's why they call them a stable asset. So that you're basically buying a turnkey asset for the most part, other than preventative maintenance. That's what you're getting.
Yeah, and what Scott said earlier is important, because you're fixing less toilets, you're fixing less
Yes.
termites, you're fixing
Yeah.
less.
And you're under the new guidance of the new laws, and like in Florida, anything built after 2000 plus is, you have better construction on the roofs and windows, and doors and everything else. Because if you saw, what a lot of people don't know, a lot of people might moan about the regulations and stuff like that, but for the hurricane that hit Fort Myers, all the houses that were built before 2000, they're all gone. They were blown away or whatever, but all the ones built on stilts and that had the anchors on the roofs and the hurricane doors, they were all relatively fine.
Hmm.
Not all of them, but quite a few of the older wooden frame houses were destroyed. It was sad.
So Bert and Michael, did that answer your question? Yeah. Okay, good. And we'll have a little bit more time coming up to ask questions of our guests. So in terms of passive income, so you invested as an LP, you invested as a GP, you're now having a fund. Are you also in a syndication
All the
as a GP?
Yes, one in North Carolina. That's a 65 unit in Charlotte.
Okay, so you you have various experience being an investor. So is there a distinction between earning passive income and an LP, GP, JV, etc.?
Yes, the passive investor, the limited partner, won't really be doing any active, work on the property. The general partners, will be, doing the asset management, which is, running all the numbers and sending out all the reports to all the investors, and giving the updates and running the meetings, the quarterly meetings or monthly meetings, however the team decides to do it. Also be
Doing the
managing
repairs.
managing the property management, who will probably be managing the repairs, and the residents doing the marketing for the property, doing all the the maintenance. If you do have staff, they're going to be hiring and firing the staff there as well, keeping up all the grounds and dealing with all the residents. So it's property management is the key, really. Without a solid property management team, the property is going to be you're probably going to have a lot of issues, and the property may go down if it's not run well.
Yes. So what you're saying is the big difference is in your time, really.
Yes. Yes.
So
Yeah.
sometimes being a limited partner, you can get a decent amount of passive income
Yeah.
without having to.
If you're aligned with the right operators or the right funds or, you know, the right people, you know, you'll be getting your quarterly distributions or monthly distributions, however it is, and eventually, whatever the timeline is on the investment structure or the business plan, you know, 3, 5, 8 years, you'll get either refinance or sell, and you'll get your money back, or you can choose to keep investing and let the money keep turning over. And with the joint ventures, you do have to have an active part, some more than others. And the joint ventures, it just really depends on what you have an operating agreement. So that's what you and the other joint venture partners decide on what the duties are. You know, it's just basically your guidelines. Like I could be, I'm in charge of on the property. I was in charge of handling managing when we put new roofs on the 5 buildings. So I drove up there and I was there when with all the guys there and just made sure all the work got done, stuff like that. You know, or somebody could be in it. We have one partner that she does all the books, you know, all the bookkeeping and all, sends out all the what's in distribution. Another partner is she has a property management company, so she handles the property management, and she's really good because she's a great property manager, and that's a great asset. She's a great partner. She's the one that invited me into the deal, and she also speaks Spanish, which is a big benefit in Florida.
In Florida, yeah, sure. So what tools are you using to manage your property? Are you using Appfolio, Buildium, anything?
For this for that property, since she has the property management company, she does use Appfolio, and I believe that software is good up until you have a certain amount of units, but don't quote me on that. I'm not exactly sure. A lot of people use Appfolio, and for me, since I'm on the syndications and we're doing the funds, I use I'm focused now mostly on raising capital and making relationships with debt and equity partners to help fund the deals. I work mostly on the capital side, the finance side. So I use a range of softwares. We're going to be building out the fund with a software platform called Avestor, where you can put all of the deals in there, and it's a customizable fund, so we can have multiple deals in there. And there's other softwares like
Cash flow
Syndication
portal.
Pro, yeah, Cash Flow Portal, Syndication Pro, Invest Next, I believe Juniper Square is another one. There's quite a few now, which they also operate the fund structure inside of it as well. But we've chosen Avestor just because we needed to get started, and it was a good all-around fit for us.
That's awesome. So in terms of, sorry. So in terms of your job being on the ocean, like, just give us a little background, like how many days are you away versus how you balancing that?
6 weeks on, 6 weeks off, but I have a tendency to have a bad habit of getting up pretty early. So I do quite a bit of work early in the morning, regardless of whether I'm on the boat or not. And then there's a bit of downtime in between once I've finished my work for the day. So, you know, there's time for calls and at nighttime, you know, and after work. Because a lot of times on the boat, we can be on like standby to standby kind of schedule. So rather than wait around, I like to stay busy. I say I work 6 weeks on, 6 weeks off on the yachts, but I do real estate 365 days a year. Well, I do take a half day off for Christmas.
Come on, you gotta take the whole day. Anyway, so business development, I don't know if you heard us talking about what a stable asset was before, but Scott was saying it's, an asset that doesn't need a lot of work right now. Like there's value add assets that need a lot of work
Yeah,
to improve them. And then there's more stable assets where there's a lot of amenities and it's newer. His buy box is the year 2000 plus, especially in Florida because there's regulations, hurricane and other weather
yeah, and a
related.
lot of other areas have, and also when you get into properties that are pre-1980, you have a lot more like you have cast iron piping, stuff like that, where you have sewage issues and things of that nature. And we had that on that 8 unit, and that was we had to cut out the whole pipe, cut open the floor, and so it was very labor intensive, and that was again during COVID. So it was, we were dragging bags of dirt out of there at almost midnight and stuff like that, and pipe, and it was a lot. And I remember saying to myself, "There's got to be a better way to do this," because I was driving down to the boat early in the morning, 5, 6 in the morning, doing a couple hours and going to the boat, then going, leaving the boat, and then doing like however many hours it took to get the job done at night, then driving home. So it was I quickly started moving towards the syndication model because it's you have more of a team. You have more
Yeah.
people on the team, and everybody has a designated duty, and that's a lot of what we do on the boats as well, is that we have a team, because without a good team, the boat doesn't go anywhere. And if you have the same thing with the apartments or commercial real estate, if you don't have a good team, the
Yeah.
property won't go anywhere. The property will go down.
No, that's key.
Yeah.
We were on a call. Our lead operator said of all the deals he's in, ours is the best team that he's working with. So that was nice to hear.
Oh, that's great. That's
Yeah,
a great team can make a bad deal great into a good one, but a bad
absolutely.
team can make a great deal go right down the tubes.
So you've
Yeah.
had experience like that?
No, but I've seen it, and I've had partnerships in other businesses and stuff where it wasn't necessarily a bad partner, just we weren't necessarily in alignment. We all didn't see eye to eye on the big picture of what we all wanted, and it's the same thing in any job or any company or on any boat, that if you're not all in alignment, things just don't get done to the right effect. But when you're all lined up on a good team, everything just kind of gets done, and slowly it gets there. And even if it's a tough rehab, or something like that, it gets done. It might be you're gonna run into issues because you never know what you're getting into when you pull something apart. You never know what's under there.
Yeah, that's a fact. And do you have any questions for Scott?
No, you've been asking some great ones. So.
Yeah, they've been really good. It's stuff, a lot of stuff that I needed to refresh my memory on. Thank you.
Oh, you're welcome. All right, well, let's open it up and see if anyone else has some questions. Michael, do you have any questions? You're on mute.
Yeah, I wanted to ask, you guys had mentioned platforms like investors, syndication. So that tells me that there are platforms by which you can raise money on. Can you guys comment on that?
Yes. The platform is basically set up. They're all relatively the same. But usually what you can do is load all the information and all the documents into like what you have on a syndication. You have usually have an operating agreement, as we were discussing earlier, and that discusses all the terms. And then you also have a private placement memorandum, because it's a private placement. It means the private a private deal. It's not really open to the public, although you can, if it's a 506C exemption, you can advertise, but it's for accredited investors only. But in that private placement, it has all the details of all of everything, of all the projections, all the where the property is, what what their projections of what's going to happen, the business plan of what they're going to do, the term of the deal. It'll spell out what's the name of the company that owns the property, who was on the team and everything else, all the details of the entire thing, and that'll be there. And then you'll also have the subscription agreement, which is basically a paper you sign that you understand what all those documents are and that you read all those things. And then you wire your money to them. And it has a portal to where you put in all your banking information and you can wire or the funds directly to them in their account as well. And then you can plug in any of the things that you for the deal in there. And then you can also, it has usually email capabilities to where you can send out updated emails and also newsletters and to all your investors, and where you can send the link out to all your potential friends and investors to look at and go through, and then you can walk them through what everything is. They're all really relatively the same, and they're all pretty good. Some are a little bit better than others in some ways, and some are better in other ways. Like there's one particular portal, and this has just been my experience, that their customer service is not as good. They don't answer the phone as easily as others, but they're all relatively the same.
Is this something that could work for your first deal?
It could. Just keep in mind that sometimes some of the softwares can be quite pricey initially. It just depends what the size of the deal is, and you may not actually need it. You might just need the legal documents and just to have them digitized and be able to send them out to your investors to look at. You have probably an investor deck that you would want to make that you could do a presentation or have them take a look at, and then have an SEC attorney do your PPM. But if you're doing a joint venture, you don't need those particular documents. You just really need to make the LLC and have the operating agreement. But I would definitely speak with an attorney, because I'm not one, and I'm not able to give you that proper guidance. That's basically what you need. And the operating agreement, you guys can put, if it's you and two of your friends or family members or what have you, you just put in there however you want control of the deal to go. And I would recommend, and I learned this one time, was that always have an odd number of people in a joint venture and make everything be a majority rule, if that's what you want. Because if you have two people and you both have equal rights, and one wants to sell, one wants to keep it, you're kind of at a standstill.
A good pro tip.
Good point. Yep.
Yeah. So, unless you want, you can also, what usually ends up happening with the joint ventures is whoever usually puts in the most effort or the most funds or what have you. That's how the deal is kind of structured. Who has more shares or more control? But just make it so that however you want to structure it is so that you can vote on things and make it to where if you have the majority, you can sell it if you need to. Because if the partnership is not going well, it's probably just best to try to make it to where everyone can get out of that. Because if it's not going well, it probably won't get any better.
Okay. Scott, one more question.
Sure.
when you move from LP to GP, and you said you're working on the capital raising side now, how did you identify people beyond friends and family?
I went to I had my meetup and I did a lot of social media stuff, identifying them. What I did was I first went to my network in the meetup, and I've been focusing on people that work on yachts that are, make a certain income. But depending on what, I would start with your profession, like, say for instance, if you're in the tech world, focus on meeting other tech people that are, because tech people generally have a high income and they're more than likely they're probably accredited investors and they probably pay a lot of tax. So you can attract a lot of people that way that are in your space, or if you're a doctor or a dentist or, an attorney, some people, there was a guy that I met one time at a conference that he wasn't a dentist, but he attracted a lot of other dentists. And he wasn't even a dentist, but he started by talking to his dentist. And then he didn't own his building. He was paying a lot of tax. So then he told him about what he was doing, and then he went from there. Then he got his friends. And then he did some, some meetups, some online groups with dentists, and then started some events. And I thought that was a very, very ingenious way because he wasn't. I think he might have been a contractor, and he talked to his dentist. So I thought that was a pretty unique way to go.
Thanks.
Oh, you're welcome.
Great questions, Michael. I do have two more questions. I thought.
Okay.
So when you're seeking a market, and I know you said Ohio was a market you were interested in, what is it about the market that you go after? Like, how do you figure out your buy box?
Well, I like the tech stuff because I used to be in the tech world before I was on the yachts. And the reason I like it is because they have support a lot of high paying jobs. And generally where tech goes, there's a lot of the other ancillary jobs that come with it. And then, you also have corporate headquarters that usually follow. Like in Columbus, you have the Intel plant that's going there and they're putting $30 billion into that area. You have, places like Sherman, Texas, which is near Dallas, that they're putting a Texas Instruments factory there. You have, I believe, Phoenix, they're TMSC, which is the Taiwanese chip factory. They're putting stuff there. And usually if the jobs come, the population comes. And then, with that certain amount of growth, I always check like the Census Bureau and make sure that the population growth is good there. And once you figure out kind of a market, you want to kind of drill down into that area. I like the secondary markets of that area because the primary markets are probably pretty expensive, or the margins might not be quite good as far as that, and the capitalization rates might be very small. So the numbers may not work. Plus, you have a lot more competition in those areas. So another thing you can track is also one-way moving from like U-Haul or United Van Lines, where people are moving. That's another good thing to check. And then look at the Chamber of Commerce of these areas. They'll give you a lot of great free information. City Data is a good website that I look at for just all the other demographics and stuff that are in the area. And then there's a couple of other crime things that you should look at. If it's just a lot of little petty theft, that's probably not a big deal. But if there's a lot of like murder and assault and arson and stuff like that, probably should stay out of that area. And I always kind of said, when we initially had our first rental house, that if I don't want to buy in an area where my wife can't go and pick up the rent. So if she can't go and pick up the rent safely, it's probably not a good area. So I don't because as you go from class A to B, C, and to D class properties, the management is, as you go down the list, the management is much more intensive, and the numbers may be great, but the management is going to cost you a lot in time and effort and money because just because the properties are a lot older and the tenants are a lot different. There's a lot of people that are struggling and sometimes have, a hard time paying the rent. So as you get further up the list, you have less of that and they become less management intensive as well.
And just to add to that, so can you define what a secondary market is? Just so.
Okay, a secondary market, like the primary market, you might call the very dense, like the center of the town where you have very expensive properties like the high rises and stuff like that. Secondary markets would be kind of like more like your suburbs, stuff like that, where you're going to have less people and probably less competition to buy the deals. And you can probably, if you try to call a broker or something, you'll probably be able to get them on the phone. Whereas in the primary markets, it might be a lot tougher because they get called all the time and, there's a lot of competition.
Yeah, no, thank you for that. And then my last question, and thank you, Juanita's in Dayton, Ohio. She's saying there's a giant Intel center going in south of Columbus and Stargate outside of Abilene, Texas. Holy cow.
Yeah, I think with the CHIPS Act, there's a map that they have there that you can track where all these things are going. And it's quite a lot more than you think. And near Columbus, there's also a data center. Those are quite big too. And when they're being built, they're very labor intensive and there'll be a lot of jobs. But I think once they're up and running, it's probably less. But you are going to have a lot of other jobs that come along with those.
Service up there.
Yeah, the ancillary stuff. I think Amazon has a data. I think it's Amazon, Google, and maybe even Microsoft are doing a data center there in Columbus. And then Dallas as well. Texas, I'm very bullish on Texas for the next 10, 20 years.
Growing.
Yeah.
Like crazy. So just to change gears a little bit. So can you explain what a fund is and why you chose to go into a fund? And as
We
an FYI, we're going to building a fund as well with our team.
Oh, great.
Yeah.
Yeah, well, a fund is basically just an investment pool. You probably, if you have a retirement, you're probably invested in multiple funds. It's basically a place where people pool their money and buy assets, apartments, or what have you. It can be used for anything, but we're using it for the multifamily assets and development because we want to be able to track everything and also put all the investments in one thing so that the investors have options within the fund to invest in other different types of things. We were going to have medical office, multifamily, and existing assets as well in there. So they are a little more of a range within the fund. And that's the reason why we're doing it. Some people do a fund just for one or two, the same type of assets, and then they can do it to where they want to grow to a certain point and then close that one off and then open a new one so that it all kind of stays together. Because if you're also doing a customizable fund, you only do one set of documents for that one, and then each of the assets inside that are within the fund. So they can move. Also, the investors can move between once they've gotten through the timeline of each one of the assets.
Yeah, so each fund, from what I understand, has to have a thesis. So you're
Yes.
going to tell the investor what it is you're going to invest in. And
Yes.
then,
Yes, it does have to have, you can kind of, it can be a wide range of things, but it kind of has to have a purpose, like you're saying. There's a lot of different ways that you can do it, but as long as it's all real estate, then it's relatively okay.
and one of the benefits for having a fund is that, the investor money is available versus, so when you come across a property to buy, you
Yes.
have the funds readily available versus the other way where you're scrambling to raise
Yeah,
capital.
and that's one of the advantages where you can continually raise money, like you're saying. That's more of a what they call a blind pool, where you just pool the money, and then when you find like say the multifamily, but you usually disclose to the investors, hey, we're getting these type of properties in this area that are going to be working kind of like this, and they're like, okay, and then so when you find it, you buy it, and
Yeah.
you're exactly right.
That's right. So, Juanita, do you have any questions for Scott? I don't know. Are you there? Maybe she stepped away. I'm I'm not sure who is business development, but I did answer your question. But if you have any questions for
Yeah,
Scott?
it's Edgar Nobles. It's Edgar Nobles.
Oh, hello. So, Edgar, do you have any questions for Scott?
No, that's it. If you answer the question, I'm good to go. Thanks. Yeah, he's really, really good content, really good information he's providing.
Awesome. I'm
Hey,
just
Donna.
going to.
I do
Hi,
have questions
Juanita.
for Scott.
Good.
Scott, thanks for being here tonight. I appreciate that. It's some neat information. And I think some of my questions kind of got answered as you went along.
Okay.
But one of my questions is, what is the best way to get involved in one of these like multifamily homes or even in a syndicate type of scenario with when you don't have a whole lot of disposable income to do it?
Well, there's the general rule is if you either bring the money or the deal, so you can all do something with it like sweat equity, where you can, find a team that you want to work with and say, hey, add value by saying, hey, I'll help find the deal, I'll help underwrite the deal. Maybe you'll be the boots on the ground. You'll be the person that'll go and look at the property, help inspect all the apartments, things like that. Like look at all the things that you're doing maybe in your job right now that could apply to helping out a team that where you can add value to where you could just tell them, hey, right now I don't have a lot of money or a lot of funds to put in there, but I'm willing to do the work or take stuff off your plate, and I want to learn as well. Um, I've helped out on teams like that before because if you find a way to add value, people will generally teach you how to do all this stuff.
Thank you. And my other question is, you've mentioned a couple of times about the meetups and you encourage us to attend the meetups. Where do you find those?
You can go on Bigger Pockets is a good one. You can go on actually meetup.com. They have a bunch of them, and Eventbrite is good. There's a lot of Facebook groups that are real estate groups. If you look in your local area, LinkedIn has quite a bit of national groups as well. Um, it took me a while. I'd be wary. Just try to find the groups and people that you align yourself with, because the first about 10 or so meetups I went to, they seemed like they were just trying to funnel me to the back of the room, try to sell me their course, their book, their the phone calls and everything else, and it was pretty discouraging. But I don't get discouraged. Just keep going to the meetups, because that's where I met, like I said, my partner, and we're still partners today, and that's inspired me to start my meetup as well. So I would recommend that. And what area of the country do you live in?
In Dayton, Ohio,
Dayton,
just
Ohio.
just east of Dayton, so not too far from where you were talking about all those data
Yeah,
centers and everything going
Dayton,
in.
Ohio.
It's like an
Um,
hour,
from Columbus, right?
It's about
from
Around.
40,
Columbus.
we're about 45 minutes from Columbus.
Okay. Well, there's a group that started in I think somewhere out there. It was called Left Field Investors. Um, but it's called Passive Pockets now. And they do events and meetups. And I believe they have a free version, then they have a paid version, but they do meetups for um, passive investors. And I'm a member of that as well. I can share the link with Donna and she can send it out to everyone. I know that's there because I've met a lot of people in the group and they all talk about investing and stuff like that. And they have a lot of YouTube videos and stuff and a lot of educational stuff in there. And they have online events as well. Um, so there's if I remember, there was somebody I met at one time, and if I remember, I'll send it to Donna because there was somebody I knew that had a meetup there in Columbus area that seemed to be pretty on the ball. Yeah, so
If you think of it, just send it to me.
I will, and so I would recommend Facebook has a lot of groups and Eventbrite I would start there.
All right, one more question. You'd said
Sure.
that you originally started by upsizing in your houses and keeping the ones from before, which I think is a wonderful idea and to get going. But can you share your story of when you actually stepped out beyond that? What was the investment that you had to put up and how did that go?
The oh, okay, went to the joint venture when I started there. That one I got, as I said, I got invited in with the partner, and we each put in. I forget how much we each put in, but um, I put in less. There's four of us in there, and we're all really good partners. So four can be good too. I just said that because we had two one time or four on another deal and it didn't go so well, but we eventually got out of that. But that one, my partner found it, and she had a property management company, which was great and still is great. Um, she she found the deal, and like I said, we walked through, we did all the inspections, we found the loan. And we went through and we vetted the loan and everything. We went through all the documents. We wrote the operating agreement and we closed on it. And ideally we were supposed to refinance in 3 to 5 years, but it's a 5% interest only loan for I believe 10 years. So it's fixed at 5% because it's private money. It was actually one of the partners found it through her network, and it's a private money deal, so it was no bank, but we still had to do some qualifications and everything. And we put down a certain amount of money, and we still have that deal today. And that led to the same partner going in on an 8 unit, which we bought and sold in 8 months, and that was right before the rates went up. And that we got lucky on that one. Things because we've got a cash buyer, and that one there was three of us, but the partnership we all kind of weren't in alignment there. So that's another reason why I mentioned that, and it kind of we decided to sell just because it wasn't really working out and the timing was right. And we all tripled our money within 8 months. So we got very lucky. And so it allowed me to go into some other limited apartment, limited partner options in Ohio as well. Another one in Cleveland and also the deal in Charlotte, which I came in as a GP and an LP. which it was where I met the guys with that deal in North Carolina. I met them online through a mastermind and a meetup, and it just kind of has grown from there. I would strongly recommend. I know can be a little discouraging and everything else when it takes a while to find the right people that you align with, but just keep going and keep showing up, and it'll eventually work out because just find the right people that you align with and find people that hopefully are much further ahead than you are. And if they see you keep coming and you keep asking questions, things will start to happen.
Thank you for that, Juanita. Let's see,
Thanks,
Bert,
Scott.
do you
You're
have
welcome.
any questions? I see you put in, oh, no questions. How about Zeph? Zeph, do you have any questions? No questions? All
No
right.
questions, but thank you. This was really good. Thanks for your good talk, Scott. It was great.
You're welcome,
Thank
guys.
Dan? Dan?
No, I'm good. Thank you. Thanks, Scott.
You're
Anna?
welcome.
Anna, any questions? Let's see who
Hey,
else.
Scott, I looked at your website. You're still looking for investors?
Yes.
Great. I sent you my contact information in there, form in there.
Oh, okay, great. Great.
Yeah, Scott, while I'm seeing if anyone else has any questions, why don't you put your contact information in the chat? Someone had asked
Okay,
for that
will
as well.
do.
Dee, I'm not sure if you're there, but if you're there, do you have any questions?
Hi, Donna.
Oh,
I'm in a listening mode.
okay.
Everything was wonderful, but I don't have any questions right now. Thank you.
Oh, thank you for joining. Always happy to see you. That's my buddy. All right, well, let's see, what other things can we just sent you a friend request on Facebook. All right,
Okay.
so let's just kind of wrap it up and, passive income, how to build passive income through multifamily investing. Wait, there was a question here. 7 messages. What is the minimum investment?
For
Your fund, is it for accredited only?
Yes, it's for accredited investors. I believe this one, there's going to be a couple of different share classes. Generally will be right around 100,000, and then the next share class will be 250,000, and then for fund managers and fund of funds, it's going to be $1 million and above.
Okay, so that's some serious money because you have a big development coming along.
Yeah, and a lot of them are, they say it's 100,000, but if you have a long, substantial relationship with them or somebody you've known for a long time, a lot of times it's usually up to the discretion of the manager. If they think it's, that you understand what you're investing in, it's usually up to them. So it may not be 100,000, it could be, they might take 50 or something like that if it's somebody they have a long-standing relationship with.
Yeah, and maybe you just want to distinguish between accredited and non-accredited and
Well, an accredited investor is usually for an exemption, Regulation D, which is a 506C exemption, which credited is a person that has $1 million net worth or more, or they have made 200,000 as a single person for the last 2 years, or 300,000 if you're married for the last 2 years. And there's also some other parameters that you can qualify as well. But I'm not, those are the main conditions.
yeah. And non-accredited is pretty much everyone else.
Yeah, but that could change also. They have in the last Congress, I believe they passed something where they were they were going to requalify what an accredited investor was with a test, but they didn't set up any parameters for administering the test or what the test was going to be. So potentially that could change, which I think it's just this is just my opinion, but I think it should, because there's plenty of people that I think that are very very sharp and should be able to. It shouldn't be based on how much money you have. It should be based on how well you know how money works.
Actually, I got a question for Scott.
Sure.
Hey, Scott, I'm Canadian. How's it going?
Hey, all right.
Wondering if I've got a lot of American friends. I've been doing real estate for 15 years. I started EXP Realty in my local city.
Okay.
Wondering if you deal with any Canadians, if you've JV with any Canadians in the past over the years, and just wondering if you had experience with working Canadians. I'm gonna guess the answer is yes, but yeah, wanted to ask.
I haven't personally, but I have friends that are Canadian that do invest in the U.S. market, and I've set up several people that weren't necessarily Canadian, but South African people that are French and stuff like that. It's not as complicated as you might think, but I have people in my network. I have a CPA and an attorney that can handle all those things if you want to know more information about that. It's not too difficult.
And so all of your projects, are they all in the States, or do you have anything international?
Nothing international right now. It's all
Okay, cool. Yeah, no, that's what I got tons of friends that invest in the States, tons of Canadian friends that invest in the States. I personally haven't yet, but yeah, I know that it's not as scary as
no,
some Canadians make it seem.
there's a guy who has a podcast. I think it's Glenn Sutherland. He is the name of his podcast, because I was on his podcast. I think it's called "I'm a Canadian that invests in the U.S." Something like that. Something like that. It's pretty easy.
He'd be easy to
great.
find.
He's a great guy.
Yeah.
And when I remember, I'll send that to her as
I'll
well.
have to look it up, but yeah, I'll send you a
I
message.
think
But
it's
yeah,
Glenn.
thanks. And
Yeah.
I came on
Feel
late.
free to reach out. Feel free to reach out. I'm glad to help you, however it works out, because I think there's some interesting options for you as well. I know as a Canadian, there's a certain couple of nuances that you have to do, to make it happen.
Well, I do real estate in Mexico as well, and I
Oh.
got tons of contacts and friends in the States, and I haven't pulled the trigger in the States. I know there's lots going on there, but it still doesn't scare me, because with world events, there's also great opportunity.
Yeah, real estate's gonna outlast whoever's in the government.
Oh yeah, I got American friends apologizing to me. I'm like, I just don't need to apologize.
It is what it
I know
is.
it's
I
not you
mean, it
guys.
is
Like,
what it
you
is.
just
I
running
mean,
into American friends.
you
Yeah.
know, some of the real estate that I've owned have been through multiple presidents.
Exactly. No, I went on my first cruise and out of Miami, and tons of Americans were knowing I was Canadian, apologizing. Like, you guys don't need to apologize. Like,
Yeah.
this is there's been things that have happened over the years, like you said.
Yeah. Look, I don't worry about stuff I can't control.
Exactly.
Yeah. But yeah, glad to help. Any of you guys, feel free to reach out if you need anything. Happy to help.
Do you have any parting words about investing in multifamily for passive income, or any other last tidbits you want to share?
Not other than that it's been something that I've developed a passion for, and if anybody needs any help, feel free to reach out. I'm glad to help. You don't necessarily have to get involved in anything that I'm doing, but I'll help you find your way, because everybody in this room probably has a different way or different idea of how they want to do it, and it's that dynamic. You can, there's short-term rental warehouses, mobile home parks, land. There's just so many ways to do it.
Yeah, storage.
Yeah.
office
Yeah,
buildings, strip malls,
Yeah.
whatever, circuses if you want.
Office, there's people converting office to, data
Condo,
centers and all kinds of stuff.
yeah. Well, we thank you so much, Scott. This was
Yes.
really fantastic
Well, I appreciate you
interview.
guys, and thank you for thinking enough of me to having me on. I really appreciate it. Thank you all.
You.
You're very welcome. And thanks everyone for coming. This recording will be up on YouTube within about a week, and you can listen to the replay if you have questions. Yes, this will be on YouTube. So thanks again, everybody. We'll stop
Thank
recording.
you
Good
guys.
night.